Ever feel like, oof, managing money, it's just this uphill battle,
Totally.
Well, today we are diving deep
Okay.
into some practical strategies to help you guys conquer your finances.
Right.
And specifically, we're tackling two big ones, debt and credit.
The biggies.
The biggies. And get this, we're not just coming here saying all debt is bad.
Right.
Because guess what? There's such a thing as good debt.
There is. So true. People are like trained to be terrified of debt.
Right.
But actually, strategically, certain kinds of debt can be really powerful tools to build wealth.
Okay, so let's unpack this whole good debt versus bad debt thing. What actually makes the difference?
So I think a good way to think about it is good debt is kind of like a strategic investment. It's money that you're borrowing to acquire something that's going to increase in value or generate income over time and ultimately give you a return on that debt.
So it's not even just like what you owe, it's what that debt is actually doing for you in the long run. Can you give us an example of that?
Yeah, absolutely. So let's say you take out student loans.
Okay.
To pursue a specialized degree, right?
Right.
That education, that could significantly boost your earning power down the line.
Right.
Like, if you're investing in a degree that leads to a much higher salary, potentially, that could yield you a much higher return than the interest you're paying on those loans.
Interesting.
So that would be considered good debt, right?
Okay.
Similarly, a mortgage, right, helps you buy a home, and a home is an asset that typically appreciates in value over time, while also providing you a place to live, obviously.
Of course, yeah.
So that's a lot different from racking up like credit card debt on dinners out,
Yeah. Wow, I never thought of it that way. So it's less about like just avoiding debt entirely and more about being strategic about it?
Exactly.
But what about those like bad debts, the high interest credit cards that I feel like so many people struggle with?
Yeah, those typically fall under the bad debt category. Yeah. And it's often because they're used to finance immediate consumption, right? Like those new clothes, vacations, that kind of thing. You have nothing really to show for it later. And often they come with sky-high interest rates, which can really trap you in a cycle of owing.
Oh, it's the worst. Okay, so understanding that difference is key.
Yes.
But what about when we are facing like a mountain of existing debt already?
Right.
We've got to tackle that strategically too, right?
Absolutely.
I've heard of the debt snowball.
Yes.
And the debt avalanche method.
Yes.
Are those as simple as they sound?
They are actually pretty simple, yeah. I mean, you can think of it as like, imagine two different paths to get to the top of a mountain, right?
Right.
The snowball method, it's all about building momentum. You focus on paying off your smallest debts first, regardless of the interest rates, just to kind of get those quick wins,
Right.
Create a sense of accomplishment that can be really motivating. So it's like you're gaining steam as you go. You're like knocking those out.
Like a snowball effect.
Exactly.
Okay. So I can see how those small victories can keep you going, especially if you're feeling, really overwhelmed.
Right.
What about debt avalanche then?
So debt avalanche is more like slow and steady wins the race.
Okay.
So with the avalanche method, you prioritize those debts with the highest interest rates first. And so this method actually saves you the most money over the long run.
Okay.
Because you're minimizing the amount of interest that you're accruing. However, it might feel a little bit slower, especially if your larger loans, they take longer to pay off.
Right. So it's about finding the strategy that kind of aligns with your personality and also your goals. But are there any like power-ups, I guess you could say, that we can use to kind of accelerate our progress, regardless of which path we choose?
Yes, definitely. I think people underestimate the power of negotiation. So don't be afraid to reach out to your lenders, call them up and see if you can try to negotiate a lower interest rate. Even a small decrease can save you significant money over the life of that loan. You can also research debt consolidation options. Sometimes consolidating multiple debts into one, potentially with a lower interest rate, can just make it easier to manage.
Yeah, for sure. Okay, those are some really smart moves. And speaking of like financial health, we can't forget about that all-important credit score.
Yeah.
Because that's like your financial reputation, right?
It is. Think of it kind of like your financial GPA.
Okay.
It's a 3-digit number that's a numerical representation of your creditworthiness.
Okay.
And lenders use this to assess the risk, of lending you money.
Got it.
And a good credit score can be your golden ticket to loan approvals, lower interest rates.
Huge.
Even better rental opportunities. It's a pretty big deal.
Yeah, it sounds like a pretty powerful little number, honestly.
It is.
But what all goes into calculating this magical number?
So it's all about your financial track record.
Okay.
Lenders peek into your credit history, and there are 5 main things they consider. The first is your payment history, which basically shows how reliably you pay your bills on time.
Okay.
And then they're looking at like the amount of debt that you're currently managing
Okay.
relative to your credit limit. They also consider how long you've been using credit responsibly,
Okay.
which reflects your experience in managing credit over time.
Okay.
The mix of credit you use also plays a role.
Okay.
So that means like, do you have credit cards? Do you have like installment loans? Things like that.
Got it.
That kind of demonstrates how well you handle different types of credit.
Okay.
And finally, they assess how often you're applying for new credit, because that can kind of indicate your level of need for credit.
So it really is like a detailed report card of all your like financial habits, basically.
It is.
So even small slip-ups could have like a big impact on that score.
They can,
Yeah.
especially over time. Yeah. Consistently paying your bills on time, even if it's just the minimum payment, can significantly impact your score over time. Remember, it's a marathon, not a sprint, right?
Got it. Being proactive is key.
Yes.
What's your advice on how we can kind of stay on top of those scores and make sure we're in good shape?
You know, knowledge is power, right? So regularly checking your credit score is actually crucial. And the best part is there are so many free options available these days. Just taking a peek at your credit report allows you to catch any errors or any potential issues early on.
Right. And then you can address those.
Exactly. You can address them before they kind of snowball into bigger problems, right?
Right.
Exactly. That's super, super helpful. We've covered so much ground today, but it's clear that, conquering your finances, it's an ongoing journey. It's not just this destination. As we wrap up, here's something to think about. What one small change will you commit to today to kind of improve your financial health? Maybe it's exploring one of those debt management strategies. Maybe it's signing up for a free credit monitoring service, or even just having an open conversation with your family about money. The power is in your hands.